Everyone's talking about the FSLY nosedive that's happening today after their announcement yesterday. I'm going to tell you what's going on and why, and talk about the bigger implications right now coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. What in the world's going on with FSLY stock? Oh my goodness, it's all over headlines. So here's the deal. What FSLY is, it's a tech company that basically provides, and I'm going to use this in very generic terms, so you techies out there, don't light me up on this. I'm just generic, okay? They provide a platform for tech companies like TikTok to operate some of their apps off of, okay? And similar to Amazon Web Services and some of these others, where their revenue, they only charge based on how much you use it. So yesterday, FSLY company, their stock, their company, they came out and announced the trifecta of bad news. Number one, they came out with an announcement before their quarterly earnings call. You know that's bad. That's strike number one. If they've got an announcement coming up, or if they've got their quarterly earnings call in a couple weeks and they come out and say, we have an announcement to make, number one, that's bad. That's strike number one. Strike two, they say TikTok, because of all the issues with the US ban and blah, 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 TikTok did not use our software as much as anticipated. Therefore, our revenue target, we're gonna miss from 73 million to 75 million. We're gonna miss that. It'll probably come in around 70 to 71 million. That's strike two, right? Wall Street does not like surprises. Yeah, really, really good ones it'll take, but does not like surprises. Number one, you come out and say, hey, we have an announcement to make, strike one. Number two, we're going to miss our sales revenue, or our revenue, strike two. All right, strike three, they said, and the future is so unclear, we're going to stop providing full year guidance. We're going to stop telling you, Wall Street, what we even expect to make in the future. Strike three. That is bad, bad, bad news. And what happens overnight trading, the stock is dropping, or did drop, roughly 30%, lost a third of its value after hours. Because of course, they don't come out with this announcement before 4 o'clock where people can panic and start selling. They come out with the announcement after 4 o'clock, markets closed. So after hours activity pushes it down 30%. That's where it started today. If you're watching FSLY stock, it started today down about 28, 30%. At the time I'm recording this, close to the lunch hour here Eastern time, it's actually rebounded a little bit with the market, and it's out now only down 23%. We'll see where it finishes the day. But here's the deal. Let me tell you a little bit about this company and the three big implications. Number one, what did I just say about their announcement? They announced that they were expecting revenue 73 to 75 million, and now it's going to be 70 to 71 million. That's not that big of a change. That is not that big of a change, okay? I understand that's millions of dollars. I get that, okay? But what is that? In percentages, that's a 5% drop, and the stock drops 30%. Why? Because the market value of FSLY is almost $10 billion. Let me say that differently. A company that has quarterly revenues of 70 million, if I do some simple math, annual revenues of 280 million, that's a lot of money. 280 million, that's a lot, is worth $10 billion on Wall Street. Their shares are trading that if you take every share, multiply the share by the share price, it's worth 10 billion. How does that make sense? How does that make sense? So that's the first implication. This company trading at such high multiples is going to be extremely sensitive to any small adjustment. When you have companies that have really, really high multiples, meaning the value of the company, the market value, the market cap, is such a high number compared to the revenue, let alone the earnings, because the company is losing money. If you have companies that are so highly valued compared to their revenue and their earnings, they're going to be very, very, very sensitive to any little change. So if you own Tesla, if you own any of these companies that have these huge multiples, any little change could mean a big adjustment on Wall Street. Second, and this is obvious, but the higher the multiples, tech companies, right? The higher the risks. So I had a friend of mine who was invested in Tesla stock, and a couple years ago and then he sold out literally before this year because it was at another high, and he said, this thing is way too risky for me. I'm getting off the ride. I'm selling this thing. You can have, even though these companies have huge prospects, and I mean Fastly, even though it's down 30% today, I mean, it's just year to date, it's done phenomenal. And over the past few months, it's been phenomenal. So you can have days where it's up 10, down 11, up 20, down 15. That is common for these types of companies. So tech companies or companies that have high multiples, they're extremely volatile. You can have huge swings on a day-to-day basis. And then finally, companies that have a high multiple, you are buying the future. What that means is if the revenue for Fastly is only $280 million a year, but Wall Street is valuing that thing at $10 billion, you are buying future value, future earnings, future prospects. So then the question is, will Fastly, in this example, be able to keep up with all of the changing trends from now until infinity to get their revenue from 280 million up to $500 million, up to $1 billion, up to $2 billion? Will it be able to navigate all of the changes in demand and changes in technology to actually be worth $10 billion actually at some point out there in the future? You are buying the future when you're buying these tech companies. So they're going to be extremely, extremely volatile once again, and very, very sensitive to changes in demand or changes to politics or changes in technology. So there you have it. For me, we own in our momentum strategy. Obviously, the only thing that has momentum right now is tech. So we own some mutual funds, not individual stocks, but mutual funds that are in tech. And as soon as I saw the report last night, I dug into our mutual funds to see, okay, how many shares of Fastly do we own in here? And thankfully, I didn't see any. So I guess that's sort of the fourth implication. When you're investing in individual stocks, news can change on a dime. And it can mean huge gains, and it can even mean huge losses before you're able to react. If you weren't in Fastly, but you're playing in individual stocks, you might think, well, if things start getting bad, I'll just quickly get out. Make note that after the market closed, this announcement came out. And it didn't open this morning at yesterday's closing value. No, it opened 30% below. You had no time to get out. You had no time to sell if that's what you wanted to do. So be aware of that. As always, consult your certified financial planner. Make sure that you've got an overall strategy for your finances and that your investment strategy is connected to your overall comprehensive financial plan. Need a second opinion or need a certified financial planner? You can contact our team. Find us online, wisemoneyshow.com, corehorn.com as well. That's Corehorn with a K, or send us an email, info@corehorn.com. All right, there you have it. Go out and take your next wise step in your financial life.